All right, good afternoon. Thank you for having me. My name is Dennis Ashira. I'm a professor of finance at Arizona State in the United States. This is joint work with Lin Hu, Kun Lee, and Feng Ngo, who are professors at Australian National University. So the title of this paper is Financial Media as a Money Doctor. And what we're going to study is whether financial media can help households make better decisions and improve on some of the financial mistakes. So we already know that households oftentimes behave in what we believe is suboptimal from the perspective of financial profit maximization, and they tend to make costly financial mistakes that are quite widespread across a variety of financial decisions. And because those mistakes are fairly costly, there's been extensive policy effort to try to help them make better decisions, ranging from more disclosure to protective legislation to optimal default and so forth. The research question that we're going to ask in this paper is, can private information intermediaries help households make better financial decisions and avoid some of the costliest mistakes? And in particular, among the private information intermediaries, we're going to focus on the role of business television. We're going to study the effect of such business channels as Fox Business News, CNBC, and Bloomberg. And the reason we're going to focus on business television is because TV is still the primary source of information for the overwhelming majority of households, particularly those that we believe are underbanked or underserved by other media, even in the age of the internet. And another interesting feature is that it is privately funded, so it potentially could help or maybe enhance the role of other government programs. And from the perspective of financial decisions, we're going to focus on perhaps one of the most important financial decisions, and that is refinancing a household's home. The reason we're going to focus on refinancing decisions is because 65% of the households own homes, so it has broad economic interest, and for the majority of households, it is the most valuable asset. According to John Campbell, the failure to refinance is the costliest financial mistake that a typical household tends to make. So why might we expect financial media to alter the behavior of households when it comes to refinancing? Well, we think of a couple of possible channels. First is that the households could be made aware of the refinancing options, and the financial media could serve as a means of financial education. Because first of all, there's programming on TV that's dedicated exclusively to refinancing. For example, Fox Business ran a series for 3 years that was called Refination. And that Refination series discussed all aspects of refinancing and was dedicated to it exclusively. But aside from the shows dedicated to refinancing exclusively, there are lots of other personal finance shows that cover managing debt, and of course, mortgages are perhaps the most significant part of like typical household's debt. But we also believe that aside from educating those households that may not be aware of the refinancing options, media could also have an effect on households who already know that the refinancing options exist, but are simply reluctant to take advantage of them because of inertia. For example, a recent study by Benjamin and Keyes and co-authors finds that those households that face even zero-cost refinancing and tend to leave a lot of money on the table, fail to respond to those refinancing offers, usually because of either procrastination or inattention. And again, these are controlled experiments where the refinancing is made extremely beneficial and sort of optimal from the perspective of sort of almost all common assumptions. So the hypothesis in this paper is, can media help focus households' attention and avoid procrastination? So we argue that media could serve as a nudge against inertia because such things as interest rates often appear in the ticker tape, so they could serve as a reminder of the low interest rates. Also, significant developments in the refinancing markets are usually covered in the news coverage, and moreover, on these financial channels, we often see refinancing advertisements, which make it very easy for the households to just pick up the phone, call the number, and refinance or take advantage of these refinancing offers. Okay. Now, how do we identify these effects? We're going to offer two identification strategies. So the first identification strategy is the entry of Fox Business News into particular zip codes and sort of the increase to access to financial television as a result of sort of Fox Business News entering a particular zip code. So let me give you a little bit of institutional background of how this works. So first of all, due to the high cost of laying cable, typically most zip codes have just one cable provider. So here's a map of New Jersey with different cable providers, and you could see that each area is served by a different cable provider marked in different colors. And if we pick even a single county, let's say Warren County in New Jersey, you see that this area is served by 4 different cable providers. And those borders are fairly idiosyncratic. They were laid in the 1980s when, due to the high cost of laying cable, this was sort of how the infrastructure got developed. And this is why the borders of why some portions of a county are covered by one cable provider and others are covered by a different cable provider, are largely idiosyncratic and technology driven, and we're pretty much embedded in the 1980s. Okay, so what we're going to argue is that channels, on average, when they enter bigger, when they make decisions as to which areas to enter at the level of a state or a county, they tend to enter larger and more affluent areas. But within those counties and within those states, we'll exploit this idiosyncratic variation in cable borders, and we'll show you that the decision to enter into a particular zip code is largely idiosyncratic, and it's driven by cable lane infrastructure. So we'll exploit this spatial discontinuity within exactly the same county, within the same state, across the border where one channel is shown and the other channel is not shown. And the reason that it's not shown is because of the cable infrastructure. So that's the first instrument. The second identification strategy is going to be the position of the channel in the lineup. Usually different networks have different channels, different rules as to how they allocate channels in their cable lineup. Typically channels that are allocated closer to the lineup, so let's say channel 10 or channel 20, are viewed more often, more easily than the same channels that are placed, let's say, later in the lineup, let's say channel 100 or channel 120. So typically the same channel reaches about 15% more households in the same zip code if it appears closer to the top of the lineup. Why? Because when you turn on the TV, you usually start surfing at the start of the lineup, or the default position is at the start of the lineup. So how do channels get allocated to different positions? We'll exploit the network-specific allocation rules that are really specific to the local cable provider. And there are over 10,000 cable providers. Some cable providers group channels by genre, or the service, for example, news channels are grouped with news channels and entertainment is grouped with entertainment. Others are grouping channels by the sister network. For example, Fox Business is grouped or paired up with Fox News, and others group them by regional focus, starting with local channels, then national channels, and then international channels. And when the new channel appears, it is placed either at the end of the lineup or the best available slot, or it replaces some of the channels that go out of business. The richness of this setting is that because there's a lot of this is driven by the idiosyncratic variation of the level of individual cable network, it allows us to generate a lot of exogenous variation in what channels are watched. So let me give you an example of the rules of allocating channel lineup. So here's the channel lineup in Spokane, Washington. You see that in this case, CNBC, which is a financial channel, is paired up with news and with CNN and Fox Business, and therefore it's shown as channel number 8, which is fairly high and attractive. Now take a look at Xfinity in Houston. In this case, CNBC, the same channel, is viewed as entertainment rather than news, and it's paired up with other entertainment channels, which places it in channel 45. So the argument here in this paper is that the same channel, CNBC, is going to be watched, is going to be more likely to be watched in Spokane, Washington than in Houston due to these channel allocation rules. Okay, so now let me go over the main findings, and then I'll explain how we get there. So first, the main finding is the effect of media on refinancing. We find that media tends to increase households' propensity to refinance when doing so is financially beneficial. So for example, the entry of Fox Business News is associated with a 7% increase in local refinancing activity in response to a 100 basis points or 1 percentage point drop in interest rates, which under most conservative assumptions make it beneficial to refinance for the overwhelming majority of households. We also confirm these findings by the instrument and TV viewership through the ordinal positions of a channel, just as I explained in the previous slide. And we find a similar, although economically smaller effect. We find that a one standard deviation, moving a channel one standard deviation closer to the top of the lineup increases refinancing by about 3.5 percentage points. So overall, these are important economic effects. A typical household reduces their interest rate by about 200 basis points and reaps financial savings of approximately $63,000 in response to refinance. What are the mechanisms that we identify? We find that households tend to, first of all, there's a greater increase in the fraction of refinance in households. So there's an increase in the extensive margin of refinancing. Households also tend to be faster to refinance and given the same incentives. So there's evidence in support of the greater attention story or greater salience brought by the media. Households are more likely to complete their initiated applications. In our data, we see both completed and incomplete applications, and we find a greater share of completed applications in response to the entry of the media, so evidence and less inertia. And lastly, there's some evidence of more comparison shopping, so households are more likely to submit multiple applications, and that results in a further reduction in interest rates. So overall, more attention, less inertia, and more comparison shopping. And finally, in the cross section, who are the most affected households? Well, these are the households that we generally like to be able to reach. These are the more sort of disadvantaged households, minorities, lower income households, households with less financial literacy. So overall, to summarize the paper, we find novel evidence of media as an educator and as a nudge or reminder against inertia. So first, let me start off by perhaps convincing you that there is a connection, there is a correlation between the reliance on media and the financial decisions of households. And I'm going to go out of our main sample, and we're going to look at the National Survey of Mortgage Originators, which provides over 100 questions, very detailed questions that allow us to look into the mechanics of the refinancing process as how it's reported by households. So what information sources they've used, how they approach it, and so forth. And so generally households say that media, about 15% of households, 16% of households indicate that they've relied on financial media in making their refinancing decisions. This is an economically important figure. If you compare it, for example, it's comparable in magnitude to real estate agents or builders, and it's more than 3 times larger than the fraction of households that have reported relying on housing counselors. That's important because housing counselors are sort of one of the main intermediaries that have been commissioned by the government to help households avoid mistakes. So there's significantly media appears to be significantly more important than perhaps the main policy effort of the regulators. And again, relying on this out of sample evidence, I'm going to start you off with just simple correlations between reliance on media and various outcomes or approaches to the refinancing process. So here are the dependent variables are going to be one of the indicators whether the household self-initiated the refinancing process as opposed to responded to an existing offer, whether they evaluated multiple lenders, whether they submitted multiple applications, and the main independent variable of interest is going to be the use of media in refinancing, which is going to correspond to the household saying, yes, they have used media in their refinancing decisions. Okay, and what we see here, these are a linear probability model, so the coefficients are easy to interpret as marginal increases in probabilities. We find that households who tend to use media in their refinancing decisions are more likely to self-initiate the refinancing process. They're about 15 percentage points or 30% more likely to evaluate multiple lenders, and they're significantly more likely to refinance in the future. So it appears that there's a correlation between reliance on media and making sort of perhaps more educated refinancing decisions. Now, we're going to try to establish this with sharper identification and field data outside of this survey evidence. So before we start on the main results, I'd like to show you sort of the identification strategy and what drives the entry of Fox Business News into particular areas at different levels of granularity. Okay, so the dependent variable here is going to be the entry of Fox Business News into a given region. And I'm going to show you different regions with more refined levels of granularity. I'm going to start with DMA, which is a designated media market, aggregated market, usually several states. Then we're going to go into the counties and then sharper into the zip codes. So if we look at the level of DMAs and counties, fairly aggregate units, we find that as you would expect, channels tend to first enter into larger states, larger counties, and sort of more affluent areas. As you would expect, they go after larger, more affluent consumers. Okay, so a larger number of tax returns, perhaps better debt to income ratios, perhaps some evidence of higher incomes. Okay. However, when you focus on the zip codes and when you zoom on the zip codes, these variables no longer matter. And the key attributes that drive entry of a channel into a given zip code, these factors are mainly driven by capacity constraints at that zip code. So the number of cable systems, total channel capacity, the number of channels that are offered, because it's fairly difficult to enter into a system that's already saturated. So we're going to argue that these channel capacity constraints will introduce an idiosyncratic factor that we'll exploit for identification to provide causal evidence of the effect of media on refinancing decisions. And again, consistent with these factors being sort of uncorrelated with demographics, you could see that when we focus on the zip level drivers, the demographic factors are no longer correlated with entry of Fox Business News into the zip codes. Sort of a key takeaway is that our identification strategy exploits this conditional random assignment at the zip code level that's driven by the fragmentation of the local cable markets and technological constraints, while the entry into the states, media markets, and county levels is driven by sort of the choice of the cable system. Once you get into the zip code, these technological constraints and give us an idiosyncratic source. Okay, now let's start with the main results. So first, on the extensive margin, we show that when it's beneficial to refinance, when interest rates declined by at least 100 basis points relative to their moving average for the last 3 years, the entry of Fox Business News makes households about 6 percentage points more likely to refinance. And that only happens when it's beneficial to refinance. You could see when we look at the post of Fox Business News entry dummy, that dummy has no effect during periods when refinancing is not beneficial. Okay. And lastly, I want to point out that these results are already, in a very restrictive and comprehensive econometric model that already has zip level fixed effects, so controlling for kind of all time persistent zip level factors such as technological composition, maybe landscape, maybe some of the persistent household characteristics, as well as county year fixed effects. So county year fixed effects will control for all county level factors that change by year, migration into the county, GDP at the level of the county, flows of goods and services, and so forth. Okay. So in this relatively restrictive model, we find that entry of Fox Business News is correlated with greater refinancing activity by households. Okay. Now, what are some of the channels through which households may increase their refinancing activity? So first, we're going to look at distance to the nearest mortgage counselor to see if media could be a substitute or maybe a complement to financial advisory role of mortgage counselors. So if we interact the entry of Fox Business News with beneficial to refinance and the distance to mortgage counselors, we find that the effect of media appears to be stronger in areas that are underserved by mortgage counselors. So this is evidence consistent with media program and could serve as a substitute for government education programs. Next, we'll look at the search activity. Again, to try to get us closer to the mechanism, we're going to look at Google searches for the terms such as refinancing or mortgage refinancing. And we find that the entry of Fox Business News is correlated with an increase in online searches for refinancing activity consistent with this education channel. And lastly, we're Another sort of interactive factor that we're going to look at is the share of incomplete applications. We're going to look at those applications that were started but never completed as a proxy for inertia or maybe inattention. We find that after Fox Business News entry, local residents are less likely to leave their applications incomplete, consistent with media acting as a nudge against inertia and pushing those households to complete their started applications. Okay. This is a nice chart that helps us visualize the effect of media on households' financial decisions. And I'm going to show you two graphs. So the graph on the right, the dotted line represents it shows the refinancing activity before Fox Business News entry, and where the variable on the x-axis is time to refinancing. Okay, and the variable on the y-axis is the cumulative probability of refinancing. So you could see that it takes quite a lot of time for households to refinance, and not all households tend to refinance on the dotted line. The red line are households that are matched on sort of most of the observable characteristics, such as the FICO score, such as the loan-to-income ratio, property value, loan amount. And what we're exploiting here is the change in the behavior of the households from before to after the entry of Fox Business News. And what we find is that this curve tends to shift to the right, where households become more quick to refinance after Fox Business News entry. They are quicker to refinance, which is consistent with sort of this nudge channel that media increases their attention to refinancing activity. So increase in attention or shorter time to refinancing. All right, so now in summary of cross-sectional evidence, we find that across financial channels, the strongest effect is for Fox, which tends to reach a broader audience. It is now the most commonly watched channel ahead of CNBC. We also find an economically similar but smaller effect from CNBC. Bloomberg, on the other hand, doesn't have a reliable effect, which might be expected because it's already targeted a very niche audience of financial professionals who we believe are already attuned to refinancing possibilities. Across borrowers, we find stronger effects among minorities, moderate income households, and government-supported borrowers. And the effect is also stronger for groups that tend to rely more on media in their refinancing decisions, and that may perhaps tend to lack other sources of financial advice. So this is an interesting result that seems like media could supplement government, perhaps educational efforts, and reach those underbanked households that we generally like to reach in financial education programs. And across locations, we find that the effects of media are magnified in the proximity of bank branches, which perhaps facilitate the physical submission of applications. All right, and last, let me wrap up with showing you or validating these results with an instrument from the channel lineup. So here we're not going to exploit the entry of Fox Business News, but we are rather going to rely on the exogenous variation in the rules, in the allocation rules of channels in the channel lineup. As we said, that on average, the closer the channel appears to the top of the lineup, the more likely it is to be watched. And here, the dependent variables are going to be measures of refinancing activity, such as the number of submitted applications or the value of submitted applications. And the key variable of interest is going to be the interaction of beneficiaries to refinance and where the financial channel appears, or how close the financial channel appears in the local channel lineup. So what we find is that a 1 standard deviation increase in the appearance of a business channel closer to the top of the lineup, which is about 35 positions. So think about moving a channel from channel number 50 to channel number 15. So such a move is associated with about 3.6% increase in refinancing activity. And again, if you believe that indeed the placement of the channels in the lineup is driven by these rules of the stations, these effects could be interpreted as causal evidence of the media on refinancing activity. Okay, so overall, let me conclude by saying that we provide evidence that exposure to business television increases households' propensity to refinance when doing so is potentially advantageous, and particularly the effects are stronger for the underbanked households who might be of particular need of financial advice. And perhaps how we're different from most of the literature in media is that traditionally media, most of the literature on financial media has shown negative effects of the media, such as chasing of past returns or exacerbating biases of households. This is one of the first papers to document positive effects of media on households' financial decisions. Thank you so much for your time.
Thanks a lot, Dennis. That was really sharp and quite fascinating. Shashwat, can I invite you to provide your discussion to this paper?
Yes, thank you very much, Professor Thomas, for inviting me for this discussion. It's always good to be at IGIDR workshop, usually in person, but we will make the best of the environment that the nature has provided us. So you all can see my screen, right? Okay.
Yes,
yes. So very quickly, I'll summarize the research questions. I don't have a lot of comments and I'll explain why. So this paper looks at the impact of financial news media on loan refinancing decisions of borrowers. To be very precise, more broadly, how does the information affects borrower decisions, and can it improve in the context of financial news media? The paper proposes two mechanisms which to me are quite plausible. One is that the availability of financial news media coverage of refinancing decisions may nudge individuals against inaction or procrastination, and that may cause them to refinance. The other mechanisms, and they show that both are at play in the data, is that the media plays an educational role. It provides information, and now that borrowers are more informed, they can make better refinancing or borrowing choices. Now the question is, a priori, what should we expect? Unfortunately, there is not much theory to guide us on the mechanism, but we know that at least in the context of equity markets, prior results largely show that financial news coverage or exposure to financial news has negative effects on equity market participants. Now this paper is throwing a wrench in that established wisdom and showing that at least in the context of borrowers, there may be a positive effect. And this paper is looking at refinancing, and I'll talk about why it may be a little bit useful to expand the scope to look at real estate decisions. Maybe that's a separate paper, but there can be differential outcome based on differential effect based on what borrower level outcomes are we looking at. So the empirical design is pretty clean, and again, to me, it's reasonably convincing. So they use two possible identification strategies and a combination of both as well. The first is looking at the staggered entry of Fox Business News across zip codes within the same county. So anything that you would worry about at the county level, which would confound our estimates, are not a big concern here, and they show that using the determinants of the timing of entry of Fox Business News across counties. So within a county, across zip codes, apart from cable infrastructure, other things don't seem to matter. Demographics don't seem to matter. Any latent demand doesn't seem to matter as well, because the past refinancing or lag refinancing doesn't predict the entry of FBN within a county at the zip code level. The second strategy is to use the channel lineup rank order, and the idea here is if a channel has a lower number in the channel rank order, then it will have higher exposure, and because of greater exposure to financial news, borrowers may, who are exposed to this news may make better decisions. And finally, they use a combination of these two in a sort of differences framework. I mean, overall, I think the empirical strategy is pretty clean, innovative, and convincing. So the main findings are that the entry of financial news network is positively associated with an increase in refinancing activity, and channel rank is negatively associated with an increase in refinancing activity. And again, remember, lower channel rank means higher exposure, so higher channel rank means lower exposure. So it's consistent. Both results are consistent. They provide evidence which is consistent with both the nudge and the educational information. The way they measure the nudge or moving away from inertia is that the fraction of incomplete applications falls down. In economic terms, it's 40% drop relative to the sample average in the fraction of incomplete refinancing applications. So more people are completing refinancing applications after initiating it. And the information channel, the measure for that is that borrowers are also shopping across different banks and probably getting a lower interest rate as a result. Importantly, financial media substitutes for mortgage counselors and doesn't complement. So in areas where there is a higher density of mortgage counselors, financial news will have a lower effect. And the effect is stronger for riskier borrowers and lower income borrowers who are probably less sophisticated, for whom the education channel or maybe even nudges should work better. So overall, I think it's an interesting and important question. It's clearly motivated. It's the result is clearly novel and it's policy relevant. If it is indeed the case that financial media can improve borrower outcomes, then it's a low-cost way for governments, at least, to improve financial literacy. It's at least in my view, it's empirically quite well executed. Any concern that I could think of, they had a test for that. Now, having a well-executed, easy-to-read, well-written paper is a bittersweet experience as a discussant, because on one hand, I enjoyed reading it. It took me less time, and I certainly learned something new. On the other hand, it's also very difficult to come up with new suggestions or criticism. So I'll maybe make a couple of big picture suggestions, and possibly, if the data permits, some suggestions on expanding the scope of the paper to other borrower level outcomes. So, is it plausible? I think so. Certainly, yes. I'll give you a personal example. I have been procrastinating resetting my home loan mortgage loan interest for about 6-7 months now. After I read the paper, the first thing I did is I called my banker, and now I have been able to reduce my home loan rates by 90 basis points. So at least for me, the paper has an immediate tangible effect. So the first big picture comment I have is on this contrasting effect on equity participants versus borrowers. As I mentioned earlier, there are a bunch of papers, including one by a colleague at ISB, which shows that exposure to financial news media may have a negative impact on equity market participants. So they may trade excessively, or they may trade based on stale news, etc. So the effect on equity investors is negative. However, this is the first paper to show a positive effect of exposure to financial news media in the context of borrowers. The question is why? Why does news media doesn't improve the decision of equity investors, and what's different about borrowers? And in borrowers, the paper looks at refinancing outcomes where there may be a plausible positive effect. The question is, can there be some negative effects at the borrower or consumer level of news exposure, even on mortgage and real estate decisions? So just like stock markets participants, maybe if I'm exposed to more news, I undertake mortgages that I don't need, or purchase a home that I don't need, or I purchase homes that I can't afford and end up defaulting later. So expose the loan, maybe the outcome is positive, but at the beginning, it could be negative. It could be positive as well. Maybe the borrower is more informed and better pool of borrowers take mortgages, which results in lower defaults exposed, but that may be something worth looking at. One reason I could think of is that there is a clear conflict of interest in case of equity. So as a news anchor, I may own stocks, which I may recommend my audience to purchase. And there is a very recent case from India, where a news anchor was barred by the Indian regulator called SEBI from trading on the stock market. Why? Because he and his family were purchasing stocks before he was recommending the same stock on news media. Maybe the same conflict doesn't arise in the context of borrowers or real estate purchases, and that is maybe what is driving this difference. But because this paper is throwing a wrench in established wisdom, it may be useful to provide at least some commentary on this contrast and what may be going on. My second suggestion, and I think this is the only reasonable comment that one could have on the paper, and I'm sure that referees will quibble about identification. They always come up with something to complain about, but that I don't think is the main concern. Maybe the scope of the paper can be improved. Although the paper does argue why refinancing is an important outcome, given that this is the first paper to look at borrower outcomes, it may be useful to expand the scope to other things. So for instance, is there an increase in loan applications or mortgage or real estate purchases as a result of exposure to Fox Business News or other news media? It could potentially have positive or negative consequences. One reason why I think there could be a negative consequences, just like stock market, there may be a marketing effect, and I go ahead and do an impulse buy of a house which I did not need because I think the prices will appreciate. So there may be some potential for borrower manipulation through a marketing effect, and that may result in higher loan applications or purchases of real estate, which the borrower may not, which may not be optimal decision for a particular borrower. Alternatively, just like refinancing, it may be interesting to look at the interest rate and mortgage shopping at origination. So the presumption is just like refinancing. If I'm a more informed borrower, I may be able to shop across multiple banks, and I am more aware of the mortgage rates, so I may be able to get or originate loans at lower rates. And as a result of that, maybe the loan approval rate improves. So the quality of borrowers who are applying for loans is improving because they are more informed, and as a result, there may be a positive effect on an approval rate. So Amit is here in the audience. He has an interesting recent paper which looks at the passage of FATCA in the US, after which credit scores were freely available for consumers. And he shows that the loan approval rate went up significantly after this FATCA law. And one reason is that the borrowers now have more information about the credit quality. And as a result, when they apply, the bad borrowers are less likely to apply, the good borrowers are more likely to apply for mortgages, and the approval rate consequently goes up. Maybe something similar may be going on here as well, worth a look. Is there an impact on loan defaults? Again, depending upon whether the marketing effect or the educational effect dominates, we could expect contrasting effect. Maybe loan defaults improve because now we have a more informed pool of borrowers, so there is lower default. And finally, it may be useful to look at credit score as well. If borrowers are getting educated and more informed, maybe the credit score improves over time. One simple reason is now my interest rate has gone down, so my probability of default has gone down as a result. In the long run, it may have a positive impact on the credit score. I mean, they do a good job of exploiting borrower level heterogeneity, but some other interesting demographic or experience based cross-sectional evidence may be interesting. So is the effect stronger for first time versus second time borrowers? Maybe borrowers who have taken multiple loans in the past, for them the exposure doesn't matter as much because they have learned from their mistakes. For the first time borrowers, they are more likely to make mistakes, so maybe the effect should be stronger for first time borrowers. Just expanding the scope, in my view, will help provide a more holistic view of the impact of exposure to financial news on the borrowers. Otherwise, I mean, I understand that the paper does, and Professor Sosuria did a good job of explaining why we should focus on refinancing, but other borrower level outcomes seem quite important as well to be able to comment on the net welfare gains for borrowers. This I don't know whether it's possible, especially because identification is going to be a challenge and we don't have detailed performance measures on banks at the zip code level. But if there is even a crude way to comment on lender performance as a result of borrowers' financial news exposure, that may help close the loop from the supply side as well. I mean, so again, very simple framework. Informed choice by borrowers may mean that the lenders are able to extract lower consumer surplus. As a result, borrowers get refinanced loans at lower rates, and the profitability of lender may go down. On the other hand, more informed borrower may imply lower defaults, which may positively impact the bottom line of banks. I understand that identification may be a challenge at the bank level, but it may still be interesting to look at. And finally, these are two minor comments. Two-way fixed, although they have an alternate strategy, two-way fixed estimators, there are quite a few papers now that talk about there being a bias with multiple treatment groups and multiple time periods because some of the observations receive negative weights, which leads to a biased estimation of average treatment effect. And now they are ready to use bias corrected estimators or robustness tests that may be worthwhile doing because it seems to be the state of the art in economics now when we are using difference in differences. But they use a triple difference strategy, and the second strategy based on channel ordinal rank is quite comforting. It may be, again, I mean, they already have two strategies, but it may be useful to look at other sources of variation in Fox News viewership. Maybe Republicans view Fox News more as compared to Democrats. So is the effect stronger in areas or zip codes with a greater fraction of Republicans as compared to Democrats? That's all. I mean, overall, interesting paper, well written, carefully executed, and at least for me, there was a tangible benefit. My home loan rates went down by close to 90 basis points. Thank you very much.
Thank you, Shashwat. Dennis, how would you like to do this? Would you like to respond to Shashwat's comments, or should we open up the discussion to the floor for a few more questions?
I just wanted to thank Shashwat for his suggestions on the paper, for thinking so carefully about the study, and for the helpful comments that he's provided. And we'd love to have a copy of the slides to share it with the authors. And thanks so much, Shashwat. And I'll just leave time for questions.
Thank you. People, now we open it up to the floor. Any questions from everybody else? So Dennis, I had a question, and I don't, I mean, this is something that came up when I was hearing you speak, and you have proposed two different reasons why, which may drive the benefits that the customer is getting. One is ignorance, and one is the nudge against inertia. And I was wondering whether it was not possible to understand which of these two factors were more important in the entire strategy that you have presented. Right? That it seems to me that when you look at the graph of the time that it has taken for closing out the applications, some of the benefits that you are recording as, yeah, this one, right? I mean, the x-axis is in months. So if a conversation is started on the refinancing of the mortgage loan, isn't it beneficial to just close it out a lot sooner, as compared with the kind of curve that you're seeing without the media? And doesn't that suggest that it is more beneficial? The TV media channel is a lot more beneficial, perhaps because of repeated signals that the customer is receiving. And that is a continuous series of nudges against inertia, as compared with really the ignorance part of it. So I was just wondering, isn't there something in this entire story that can actually say why it is that this strategy is delivering so much benefit for the customer? And between the two of ignorance versus a nudge against inertia.
Yeah, this is a very good point, and that's very consistent with our reading of this data. So if you look at the y-axis, so the y-axis here is the cumulative refinancing probability. This is largely the sort of the extensive margin of how many households are reached, right, or what fraction of households tend to refinance. And what you can see here, or at least our view of the data, is that the main move is from the curve moving from the right to the left, as opposed to the curve moving from the bottom to the top. So moving the curve from the right to the left is essentially accelerating the refinancing decision, and mainly the nudge mechanism that Shashwat also said was at play with his own decision. Here, as you can see, that we're shifting the time to refinance in maybe by something like, I don't know, 10, 15 months with the presence of Fox News, which is a lot of saved interest and costs and so forth. Now, if you look at the fraction of households that are reached, at least on this graph, there's maybe a little bit of an effect, but it's not as strong. So based at least on this evidence, and this is probably the cleanest evidence because we're using a matched sample of borrowers, that are matched in all reasonable characteristics, like exactly the interest rate on the loan. So income levels, FICO scores. So these are as close as we can get to observable counterfactual that borrowers have very, very similar incentives to refinance. So conditioning on having very similar incentives to refinance, it appears that the attention channel, the nudge channel, seems to account for the bulk of the results. That's our view of data.
Yeah, no, and I think that has implications on when policymakers think about how to improve improve financial outcomes, right? That when there is an intervention that is designed, and this may not even be just the financial regulator or the policymaker, it's even for the businesses that want to get customers to engage more in decision making in the financial space. That there's a whole lot of focus being put into improving awareness, improving information. Whereas what it seems to me here is that there's a lot more of a case to be made that it's to give nudges to constantly remind people that it is important to think about a reinvestment or a refinancing decision, to relook at these things as compared with, I don't know, telling people what a mutual fund is or what equity is and what's good about one product versus the other. So I think it has deep implications for the kind of interventions that we have discussed even in India on whether to improve awareness or to improve or to reduce the inertia. And I just wondered whether this paper was going to help us think about which is more important.
Yes, thank you so much. The other point that we haven't disentangled quite cleanly in this draft, but there's hope to do this maybe in the later rounds, is one of the ways to fight inertia is to make it very easy for the customer to refinance. Pick up the phone at zero cost, make a call, and they'll walk you through the process and maybe help you file the application on the phone. Okay, so part of this barrier, or sort of the reduced cost of refinancing, is through these financial advertisements in real time that tell you, okay, here's, we'll give you this bonus, or we guarantee that you will save at least this much. This is the phone number. If you call right now, we'll give you some of the additional benefits. So this is sort of, in addition to reminding the consumer that it's important to refinance, it's also an easy way for maybe perhaps a less sophisticated consumer to get access to refinancing with, in real time with very little investment, and you don't have to go anywhere, research anything, just pick up the phone and call. So what we're hoping to do is maybe to get data on the advertisements, so which firms ran advertisements
Exactly. Yeah.
at that time, and then see whether the refinancing activity, or see the difference in refinancing activity of those firms that advertise versus other banks. So if Bank of America comes up and advertises their refinancing program, we're gonna, since we know the loan originator in the HMDA data, in the loan application data, we'll be able to see whether the, how much the refinancing activity increases at Bank of America that advertised versus JP Morgan that didn't advertise. So that's an additional perhaps policy implication of making it easy for the borrowers to refinance.
Yeah, no, I mean, I completely agree. That was my next level of questions, that if it is indeed nudging and a repeated lesson to go and complete the application, do the refinancing, then certainly the question is who's bearing the cost of that. I mean, sure, it's inexpensive according to your story for the customer, but certainly if it's a nudge, it helps to have the repeated messaging going out on the television media. And then my question was, what is the time series of the advertising revenue from refinancing market participants, right? So the banks that you mentioned, can we see it in the channels advertising revenue? Do we get it broken up across different kinds of sectors? Do we see that when this kind of business entry happens, there is an upsurge in the kind of advertising revenue that we can see, which is correlated with the loan application or the refinancing applications that happen?
Yeah, so that's sort of the foundation of the private model, right? Remember, sort of private financial intermediary model, right? Remember, we started off the paper by saying, can we offer a market solution to customer education? Because education is costly, somebody has to provide it and somebody has to pay for it. So one possible solution is to offer such education through money management shows, and the way that business media gets compensated for it is because they get greater advertising revenue for those shows, because particularly those shows attract the audience that is attuned to improving their finances. So if so, then that seems like a win-win model where the media is interested in increasing their audience and reaching those underbanked households, because that helps increase their viewership. And the reason they're interested in increasing their viewership is to get better advertising revenues from financial intermediaries that advertise in those high-profile shows, right? Because we know advertising is the cost of advertising is very correlated with the viewership of a particular program. And if that's the case, then that seems like a great solution, at least to me. I don't know, you may have different thoughts, but where we could get media to provide the role of education and financial intermediaries and advertiser help pay for it.
But that's also troublesome, right? Because you may have a higher probability of mis-selling. That happens because there is an explicit cost involved. And the question is, who bears the cost? And I'm not sure I see in this entire story where the cost angle is getting absorbed. One is tempted to think that ultimately the customer has to pay the cost. And the question is, do we understand where and how?
Well, the customer, I mean, there's always banks refinance loans because it's profitable for banks to refinance loans, right? But we hope that there's joint surplus, right? That's available both for the bank to make some profit and for the customer to improve their loan rates. And that seems like a better solution than leaving things as they are, where the customer doesn't refinance and doesn't reduce their loan rate, and the bank doesn't make any money. I don't.
Yeah. So I think Renuka has a question that she's posted in chat. Renuka, do you want to ask the question?
It was just a response to what you guys were talking about in terms of, aligning the incentives of the financial firms and customers. So Susan, you pretty much asked the same thing that I wanted to ask.
Great. And then the other hope is that after a finance show like Refinancing or Refination or a personal debt management show, when the customer sees those advertisements, they're going to be more educated about asking the right questions from the refinance and bank, and maybe better navigate in the refinancing process, as some of the survey evidence suggests, right? So the survey evidence that's taken out of context, out of sample from a survey of mortgage originators says that those that relied more on media tended to contact more lenders. They tended to compare more interest rates, and they seem to be more comfortable with the refinancing process. So that's the hope, that they may get the nudge, but they will be able to better navigate through.
Great. Anyone else with any other questions? Okay. In that case, I think that I will step in and I will call this workshop to a close. I would like to thank all of the people who sent in papers, took the time out to do the presentations. I'm particularly thankful to our discussants who always give terrific comments. I echo Shashwat in saying that these discussions are rich. We get a chance to see papers that we would have not had the ability to enjoy, with the authors doing the presentation, so it's great. But at one point in life, it'll be even more rich when we have an opportunity to meet each other. And I just wanted to say thank you to everyone who's also been on this workshop, listening in, writing in with comments and suggestions and questions. Thank you all for having contributed. I'll just close now with one announcement, that every year we try to have one research workshop of this nature on household finance. But the other place where we get an opportunity to meet up and chat about household finance and complain about regulators and market participants and say wow about the cool data sets that are showing up in this area and the new findings, is the Emerging Markets Conference, which is an annual conference that we have in December. This year it's on the 13th, 14th and 15th. And the hope is that this year we will have a physical conference. So Shashwat, if you are listening, this is an opportunity we are hoping with all fingers crossed that the third wave, if it does happen, is something that we'll be able to manage so that we'll have a physical conference on the 13th, 14th, and 15th. Please send in papers. I think the call for papers is still open. I will request Jyoti to send a link to that conference. We will definitely be having a household finance session, and it'll be terrific to meet with all of you and have the richer conversations at face-to-face meetings to have. So thank you all very much and hope to see you in December.